Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money.
I'm Evan Barnard, filling in for Paul Winkler. You can get his full, detailed brain next week, but you're stuck with me today, and so we'll blend some philosophy with a little bit of nerdism as well.
Hey, at least you're in the studio.
There you go. The be here or be there or be square. I was actually as you know, I tend to get places really early. And there was like 3 wrecks on 65 or people pulled over or something like that. I'm coming up from Marshall County, and I'm like, cried, I'm going to have to call RJ and say, play something for like 10 minutes. But I got here.
So in other words, it's another day in Nashville.
Right. At least I wasn't on 24.
No, I had to drive 24.
Oh, gosh. Okay. So I'm going to talk about something at the start of this hour called the investor's dilemma. We talk about this with clients a lot. We put this in quite a bit of our workshop content. But because of something called the investor's dilemma, it's very hard for investors to relax, and it leads them to living investing lives of quiet desperation. And so let's go through this dilemma, and it's because of this that folks get themselves into trouble. So just kind of, picture a circle. Don't write this down if you're driving down the 65 or 24. Just pull the podcast. But at the top of the circle, just put a square and fill it. It says fear of the future. I touched on this last hour, but I'm going to expand on it here. Most people approach investing with a basic fear of the future. I don't want to make a mistake. Are things going to turn out the way I thought? If Trump wins, I'm going to do this. If Harris won, I'm going to do that. If Carg Island has another attack, what should I be doing with the portfolio? Just there's this constant fear of I want to dodge that bullet if it's coming at me, or I want to make this, huge return on an investment because I picked it just right and I bought at the bottom and sold at the top and so forth. So we're afraid of the future. So if you're afraid of the future, what do most people then tend to do? They tend to try to forecast or predict the future. And even if they can't predict the future, I certainly can't, they may subscribe to a newsletter. They may subscribe to 2 or 3 magazines. They might religiously watch Fox Business and CNBC or, whatever other news program might be on, and trying to see, okay, what was the jobs number? What's the unemployment? Is the Fed going to raise interest rates? So I'm going to listen to this columnist that, they tend to get right over time. And if you're looking for someone that can forecast the future, what do you tend to rely on to pick that person? And that leads to the third step of the investor's dilemma, which is track record investing. Now, in the case of a restaurant, if you've had a good experience 2 or 3 times, or several of your friends, let's take a recent addition to the Nashville family. If you've never eaten at In-N-Out Burger and you see lines 3 hours long outside a hamburger place, you have a pretty good idea either that those are good hamburgers or at least they have a very loyal following and they're not bad hamburgers. And for the record, I actually haven't gone to any of the new ones here, but I get out west enough that I have had In-N-Out Burger, and it is tasty. My wife's cheeseburgers are probably better, but I think anything made at home tastes better a lot of times. But it's great if you're in a hurry. So track record investing, just because an investment has done well, just because some prognosticator or guru in the past has done well and they wrote a book or they, had a documentary about them or they have a news show and they made some predictions in the past, has no bearing whatsoever on if they're going to be able to predict something accurately in the future. Now, there's a whole industry built around this track record investing. Many of you will be familiar with the term Morningstar, or the company Morningstar. And they're basically a huge data house. I've actually been up to their buildings in Chicago on, I think, Wacker Boulevard, of all things. But they basically track the return history and have a bunch of data on the alpha, what's the average investor make, what's the return of this fund, what are the expenses, what are the holdings, and so forth, that somebody can look at either for a very expensive subscription that has a lot of detail, which is what I pay and all of us pay, or even a discounted thing, trying to look up and see which mutual fund or which stock should I do based on the track record. And as you know, we're no fans of track record investing, but most people are familiar with that Morningstar style box. Well, here's an interesting thing about Morningstar. And they're a legitimate industry, right? This is it's not a scam or something like that. We just don't think that you should rely on all that history of a fund, not the history of the market, but the history of a fund to make investment decisions. But what caused me to bring this up is I received an email yesterday, and it says, "Dear valued client." I always like that when it doesn't have my name and says I'm valued as a client. I would rather just say, "Hey, since its launch in 2011, Morningstar's Global Equity Classification Structure, GECS, has been a cornerstone for investors, enabling them to evaluate economic similarities and differences across stocks and portfolios with precision." I would debate the precision argument, but I go on. "Over the years, economic and technological advancements have necessitated a closer alignment with industry standards in the evolving market landscape." Those of you listening that have lived in the corporate world, your heads are already, I won't say spinning, you're probably banging your head against the window in the car or the wall in your garage just to hear the corporate speak of closer alignment with industry standards in the evolving market landscape. To address these changes, we're excited to announce a comprehensive revamp of the GECS, which will be renamed the Global Entity Classification Structure to reflect its expanded scope. Fortunately for them, it still has an acronym, GECS. They changed equity to entity. Go figure. This update comes July 13th. Why is this happening? The updated GECS is designed to better align with today's economic realities and empower investors with tools to navigate emerging industries using sharpened industry definitions, introducing new classifications for key industries, and so forth. We aim to provide a more robust framework for informed decision-making and portfolio optimization. Boy, that sounds really easy to do, doesn't it? They're going to have a structural revamp. They're changing the name. So here's the deal. They're now going to break securities into 3 super sectors, which I'm guessing are stocks, bonds, and cash or something like that, and 11 sectors. There's 60 industry groups under those 11 sectors and 156 industries, ensuring comprehensive coverage of both traditional and emerging industries. So why am I kind of laughing at this letter? Well, it's in the context of people are constantly looking at this kind of information to do track record investing. And the bottom line is the data overwhelmingly says that chasing performance does not work at all. And it's not because people trying to chase performance are stupid, and it's not because mutual fund managers are stupid. They're all run by very intelligent people out there. And that's really the problem. You have all of these incredibly intelligent people trying to not overpay for a stock when they buy it, trying not to sell it for too little when they sell it, And that creates a very efficient market. But now you're going to have people pouring through all of this new data and trying to construct I think that consumer cyclicals are going to do better, but I'm only going to use these 3 industries. And I think it's just going to become incredibly confusing for the investor. And that leads to the 4th step in the investor's dilemma, which is information overload. At some point, you just get so much information that you just shut down. I was actually listening. I can't remember if this was a podcast or I was reading something, but there was a psychologist or psychiatrist or child development person, whatever, and they were being interviewed, and they talked about crying of a baby. They tend to go to sleep. A baby will just go to sleep if it gets overwhelmed. And it's really a defense mechanism. I've kind of always wondered at why our boys went to sleep when we turned on the vacuum cleaner, but maybe it was an overwhelm. And so that's why they went to sleep. But it's just a defense mechanism of if there's too much to process, I am going to shut down is basically what happens. And the interesting thing is we never really lose that tendency. If we get overwhelmed, I don't care if it's at work, at home, investment research, working out, you name it, it is going to, you're just going to hit critical mass and you're just going to shut down. Well, when you're picking an investment, shutting down after information overload isn't necessarily the best option that you want to have. Let me give you an example of how overloaded that can be. If you were to, this was a few days ago, but if you put, investing or just invest in Google, it has 3,270,000,000 results. And that was produced in 0.31 seconds. So if all you did was spend 3 minutes per result, that's 18,664 years. And I'm an optimist. Very much so, but I'm going to say I don't have 8,664 years left to worry about a portfolio. So if I get overwhelmed, what do? I make an emotion-based decision. Do I like that story? Do I think Elon Musk is really smart? Do I think Jeff Bezos is a doofus? Whatever. And a recent example of an emotion-based decision, I ended up watching it twice on CNBC, actually. Alex Parr, who is the CEO of Palantir. I don't even know if you'd call them a software company or what, but they handle information, and they're heavily involved in the Defense Department along with commercial ventures. But it was a really good interview. He was very complimentary of the troops. He wanted to make sure that the focus was on the warfighters over in Iran, that it was on the, I'm drawing a blank. The Marine Colonel, Lieutenant Colonel, Oliver North, soldiers, sailors, airmen, and Marines, and Coast Guard, and now Space Force, that they're the ones at the tip of the spear, and that's where the focus should be. But then, he went on to have this interview of what Palantir is doing and, how is it supporting the war effort and, answered questions openly and so forth. And so if you're making an emotional decision, you might say, wow, I'm going to invest in that stock because this guy's really cool. He's patriotic. I think that's great. Well, that stock has a current price, and that current price is based on the collective wisdom or ignorance, however you want to look at it, of the 8 billion participants in the market on this planet. And they factored in what they think the current earnings and growth and all that is, and there's a stock price. So you don't have any expected return that's higher than the entire market at any one point in time, other than this emotional decision that I think this guy's going to do better than everyone else. That can happen on the other side too. He could have said, you might not like war at all. And then, frankly, this is what makes a market. And you may say, well, I can't believe he's supporting the war effort. I'm going to sell my Palantir stock. Well, that's still just as much of an emotional decision. So you don't want to be doing that. So we start with the sphere of the future. Then we try to forecast or predict the future. Look for a track record to see who got the future in the past correctly. Get overloaded with information. Make an emotion-based decision. And when you make decisions emotionally, in almost every instance, I don't know too many men that have made a spreadsheet of choosing their spouse and coming up with a rubric of, okay, this is the highest probability for a wonderful marriage. So there's a couple of reasons where you want to make an emotional decision. But again, not with investing. You end up breaking the rules. And most of you know the basic rules of investing. Buy when prices are low, sell when prices are high, hold on to things over a long period of time. Don't be trading in and out. And be diversified. Don't have it all in one or two positions that you think are going to do well or got rid of because you thought they were going to do poorly. But you end up breaking those rules. And just like in criminal enterprise, just like cutting class in school, and certainly in building a portfolio, when you break rules, you end up getting performance losses. And you underperform the market because of all of that activity. You're taking the risk of the market, but you're not getting the entire performance of the market. And all of that dilemma leads to not enough money and no peace of mind. Because after you've gotten those performance losses, what happens? Now I'm afraid of the future again, and that cycle just continues. So we will touch on how to solve some of this problem when we come back. That's a great summary of the challenge that investors face, or I'm thinking it's a great summary. That's up to you. You're listening to the Investor Coaching Show. I'm Evan Barnard on Super Talk 99.7 WTN.
Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax.
Hey, so we talked about the investor's dilemma last segment. And before we get into the solution of how to build a portfolio so that I'm not tied with that, I wanted to touch on a dilemma that goes on in the world. And I think we've seen some of this play out recently, and particularly just in the last few weeks. But, there is also a global dilemma that causes worldwide suffering. And so, if we say save the investor, save the world, what are we saving the world from? And why are we so interested on saving the investor around here? Well, this global dilemma starts with the same fear of the future. In this case, it's not that this investment is going to, go south, but that there's going to be a problem in the world. Is a meteor going to strike, whatever. And so what happens if you have this fear of the future as a government is that can lead to communism and socialism. And we've seen that. We've seen that in Cuba, saw that in Venezuela. That's actually been being, dealt with some. There'll still be a lengthy transition, I'm sure, there. Cuba has now made its way back into the news also with the aging of Castro's brother. I think he's 94, I think they said. China, of course, Russia, and notably Iran. And so when you're afraid of the future, you want to try to control things. And interestingly enough, if you look at, there's an index of economic freedom that's put out by the Heritage Foundation. The most free countries, number 1, Singapore, 2, Switzerland, Ireland, Taiwan, Luxembourg, and U.S. actually comes in at number 26, which to me is a horrible black eye, but we're still at the top end of the spectrum. The least free countries, Iran, China, Russia, and India. And you'll notice in the free countries, they have a GDP that's like 50 times the GDP per capita of a less free country. Luxembourg tops the list at $137,000 of GDP per capita. The U.S. is about $85,000. China is at $13,000, and Iran was at $47,771. And so with this communism and socialism, it leads to despotism. Well, what happens when we have a despot on the world stage? Mao Zedong was responsible, you could say, for 45 million deaths. Adolf Hitler, 18 million. Joseph Stalin, 20 million. Pol Pot, 2 million. And Vladimir Lenin, 1 million people. And now we have the terrorism issue. And so despotism ultimately leads to poverty. And, you know, you have no property rights, you have starvation, you have disease, and so forth. And when you have this despotism and then poverty, people don't like to be poor forever. And if they think they have nothing to lose, they're going to fight. And that ultimately leads to war, either because the people uprise and it's a revolution, or the country runs out of resources and decides to go to war with a neighboring power because they're going to take their resources. And ultimately, in the 20th century, war has accounted for 424,000 Americans killed in combat in the 1900s. And so, you know, it's a big deal. Ultimately, war leads to death. Death leads to abuse of fundamental human rights, and then you're back to this fear of the future, just like the investors. And that cycle continues itself. And it's incredibly hard to break that cycle, because ultimately that leads to human suffering. Well, who's going to get us out of this? In my view, it's the entrepreneurs and the innovators. Communism is not going to be solving technology problems. It's not going to be solving hunger problems. That model tends to create problems. And so, Adam Smith, talked about the wealth of nations and so forth. And we have the ability to solve this. Bill Whittle had a video several years ago. He was a conservative commentator, an early, influencer, webcast, whatever. And, he said, you go to a lot of third world countries or even heavily impoverished areas in the U.S., and there may be, a stream running down the side of a street and there's sewage in it, and maybe the kids are playing in it or something. And most people look at that and just say, oh, we've got sewage in the river in the street, and that's the way it is. Entrepreneurs look at that and say, wow, how do we get the water out of the street? How do we fix this? How do we dry that up? How do we shore this? How do we make it clean and safe? The entrepreneurs are ultimately the freaks of the world. Most people just let things stay as they are, and they don't care about fixing it. They don't come up with radical new ways to do eye surgery. I don't know about you. When I get down a little bit, I'll Google YouTube, search YouTube, and I'll plug in the videos of these kids that are finally getting cochlear implants, and they've heard their parent for the first time, or one gentleman that's, I think he's been blind, and he has these now special glasses that he can now see the shape of his wife digitally recreated in his brain. I mean, it's just remarkable. And you see these tears of the loved ones and so forth. That's all entrepreneurs solving the world for that.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.